What's up, guys? Welcome back to the channel. Welcome back to another video. If you're stopping by the channel for the first time, please consider subscribing to my channel. And while you're at it, smash that like button. I really would appreciate it. Also, hit that post notification bell so that you're notified every time I upload a new video. Be careful down in the comment section of the videos. A lot of spam, a lot of scammers. I will never ask you to contact me by WhatsApp or Telegram. I also do not invest money for my subscribers. So please, guys, don't get yourself scammed. If you want up to 12 free stocks, Webull is going to give you up to 12 free stocks. When you open a new Webull brokerage account, put at least $100 in your brokerage account. They're going to give you up to 12 free stocks for just trying out their brokerage app. Then you can take that $100 through fractional share trading and start buying your favorite companies and your favorite ETFs to build wealth. There's a link down in the description box of the video. Click on that Webull link. Open up your new account today. Go get that free stock. Go get that free money. The Federal Reserve will be meeting for the first time in 2023 on January 31st and February 1st. Now, it is widely expected that the Fed will increase the Fed funds rate, aka short-term interest rates, by 25 basis points. That'll be the first rate hike of this year. Now, they'll probably have two more rate hikes, 25 basis points apiece, a total of 75 basis points in rate hikes for 2023. That's only if inflation continues to show signs of coming down. Now, we did get the December CPI report a couple weeks ago, and it showed that inflation is coming down for the third month in a row. Right now, currently, inflation is around 6.5%. Not out of the woods yet, though, because we really need inflation at 2%. So got a long ways to go, but making good progress. And I think the Fed has accomplished what they set out to accomplish in 2022 when they did 7 rate hikes. They wanted to slow down our overheated economy. And I think they did that. Look at the used car market. So post-pandemic, 2021, used car prices were through the roof. And the reason they were through the roof is because we had very little inventory of new cars. So when you don't have a lot of inventory of new cars, used cars skyrocket. They go up in value because of that old supply versus demand. If we look at 2022, going into 2023, there's not a problem with being able to go to a car dealership and buy yourself a new car. So that means used cars prices start coming down. Also, with the Fed increasing short-term interest rates, that has impacted used car loan rates. Back in 2021, you could probably get a good used car rate in that 4 to 5% range. In 2023, you're probably in that 10 to 13% range. And that's with good credit, guys. So that has really put a damper on demand because nobody wants to go out and spend all this money for a used car and then go out and have to spend a lot more money for the monthly payment because of what? A high interest rate. So the Fed did exactly what they wanted to do. They wanted Americans to stop buying things. And used cars are one of those things. And they accomplished that by raising short-term interest rates. The other thing that the Fed wanted to accomplish was to cool down the housing market. And they did that as well. Think about it. post-pandemic, probably 2021, you could have gotten a 30-year fixed rate mortgage in that 3% range. Fast forward to January 2023, you're talking about a 7% interest rate on a 30-year fixed rate mortgage. That is more than double, guys. So they accomplished what they set out to accomplish, to cool down the housing market by increasing short-term interest rates, which indirectly affected 30-year fixed rate mortgage rates. When you have high mortgage rates, it does what to demand? Goes down. That's right. Why? Because affordability. Somebody who takes out a $400,000 mortgage, 30-year fixed rate of 3%, their mortgage payment is about $1,700 a month. But on that same $400,000 mortgage at a 6% interest rate, they're at about $2,500 a month. So you can see, just by doubling the interest rate from 3% to 6%, your monthly mortgage payment goes up by $800, which has impacted affordability in our country when it comes to people going out buying homes. So therefore, the Fed did do exactly what they wanted to. They wanted to cool down the housing market. They wanted to cool down the used car market, and they've done that. I go out to eat from time to time, and I can tell you, man, everybody's out eating dinner at restaurants. I went to my local mall outlet where, you got outlet stores like Nike and Adidas and Cole Haan and I went out there, a couple weeks ago thinking, let me get out here, man. I should be able to get me some good deals. Shouldn't take me that long. When I got out there, guys, it was packed. And I'm saying to myself, we got inflation at 6.5%, but every restaurant I go to, it's packed. Every mall I go to, it's packed. People in line buying stuff. And we still got inflation at 6.5%. What is going on? When are people going to get the message that they got to stop buying stuff that they don't need? Well, it goes back to the labor market. And that's one thing the Fed has not been able to get cooled off by increasing short-term interest rates. The labor market is still hot, man, right? And as long as the labor market is hot and people have jobs, and people are in increases in wages, they're going to spend money. And as people continue to spend money, inflation is going to stay up. It's going to stay high. And we are not going to be able to get inflation down unless the Fed can cool off our overheated labor market. If it doesn't cool off, we may get thrown into a recession because why? The Fed is going to keep increasing those short-term interest rates higher and higher and higher and force us into a recession. Drop me some comments down in the comment box, guys, and let me know what you think about the softening used car market, the softening housing market, and the strong labor market. When will the labor market soften? I don't know, man. Drop me some comments and let me know y'all's thoughts. If you want those 12 free stocks from Webull, click on that link down in the description box. Open up that new Webull account today. Go get that free stock. Go get that free money. If you're stopping by the channel for the first time, please consider subscribing, share the video, smash the like button. Thoughts become things. If you can see it in your mind, you can hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. And I'm going to catch you on the next video. Peace. Today's video is sponsored by my company, RF Financial Consulting. And in my company, I work with individuals just like you through financial mentoring and coaching sessions. And in those 1-hour sessions, we talk about strategies to help you get to your financial freedom, whether it be through real estate investing, stock market investing, creating additional streams of income, credit card arbitrage, or starting and growing a business. If that's something that you might be interested in, there's an email address in the description box of the video. Send me an email and let's discuss if I'm the right fit for you.